Next up, we've got our relationship between balance day adjustments and reversing entries, which is something that I touched on earlier. So reversing entries must occur the day after balance day in the new accounting period. So usually we think of this as the 1st of July to reverse the balance day adjustment entries that were made. So this returns the revenue and the expense accounts that were involved in those balance day adjustments to the state that they were in before those balance day adjustments occurred. So reversing entries are also required to close any temporary asset or liability accounts that were established on balance day to alter any revenue and expense accounts. Reversing entries are needed for 4 of our balance day adjustments, which are the main ones that we usually think of: prepaid expenses, accrued revenues, and unearned revenues. So 2 of these are assets and 2 of these are liabilities. At the end of the lecture, I do have some tips, and one of my top tips always for accounting is something that I use to remember which ones are assets and which ones are liabilities. So it's this idea that pairs are assets. Now, pairs stands for, it's written as like an acronym, so all capitalized. The PE in pairs is prepaid expenses, and the AR is accrued revenues. So prepaid expenses and accrued revenues are assets, and by process of elimination, you know that the other two, your unearned revenues and your accrued expenses, must be liabilities. So here, prepaid or unearned adjustments. This involves the reversing entries involved shifting the adjusted figure back into the revenue or expense account. And for accrued adjustments, the reversing entries cancel the expense or revenue when it is paid or when it is collected. And that means that those revenues or expenses will not be listed in the new accounting year's statements. So it's important that when it's happened, it's then cancelled out. So you've got this blank slate to work with for that new accounting period. The relationship between net profit based on accrual accounting and net cash from operating activities. So accrual accounting, as I mentioned earlier, involves recognizing revenues and expenses in the business's records when the transaction occurs. So when revenues are earned or expenses are incurred, instead of when you're actually reimbursed or when you actually pay for the product or service that you got. So net profit based on accrual accounting is calculated by subtracting accrued expenses from accrued revenue. So hopefully your revenue is greater than your expenses, and so you're subtracting those expenses from the revenue to hopefully end up in a positive figure there for your net profit. If it happens that the accrued expenses are actually more, then you're going to have a loss instead. So due to the nature of accrual accounting, net profit based on accrual accounting is not actually reflective of the volume of cash made or spent during the accounting period. So this is where we've got net cash from operating activities, which is also called net cash flow. It relates to the cash made through the business's operations. It's not affected by this idea of accrual accounting. So it's the net change in the total cash that a business makes or loses in an accounting year, how that figure is changing. So the ending cash balances for different reporting periods are required to calculate net cash. So you're looking at net cash at the end of different reporting periods, so different financial years, and then you're looking at a comparison, so you can see that net change in that cash in terms of what it's making or losing. in an accounting year. So the important difference between net profit based on accrual accounting and net cash from operating activities. So while a business may make a substantial profit, it may have limited cash to repay its debts and thereby be at risk of insolvency. So just because you're making a profit, and just because you're making a substantial profit, doesn't mean you actually have the cash with you to be paying your immediate financial obligations. Examples of some accounting situations that could cause the net profit and the net cash flow for a business to be quite different are things like allowing customers to pay on credit. So I mentioned earlier, if you've got an accounts receivables, um, they are paying on credit, meaning you're not actually getting the money right now. You're earning the money because they're getting the product or they're getting the service, but you aren't being reimbursed straight away for those products or those services. You could also be repaying a loan, prepaying an expense, or purchasing a non-current asset. So those things can be significant. You're making a substantial profit, but you've got quite a bit of outlay there to cover expenses and loans and new assets that you're purchasing. And that means that the actual cash that you've got on hand may not be enough to cover the other debts that you need to repay.